To each of you. Alexander and Haberman is proud to be hosting our Spring 2022 Speaker Series. Today's presentation, A Reverse Mortgage Cinderella Story, presents a financial tool that has grown to represent $350 billion of spending power by consumers. This is out of an estimated $7 trillion of home equity nationwide amongst those 62 and over. We will be reflecting on this tool with all of its benefits and the changing contours of the industry as explained by Dominic DesMarais. Later in the series, we'll hear about caring for aged loved ones, with an emphasis on selecting the site and providers for that care. We'll also have a session on one of the oldest and polarizing of financial tools, the annuity, and its essential role in income planning. And finally, to wrap up our spring series, we'll have a conversation around estate planning. As always, Alexander and Haberman does not practice or hold license in any of the specialties of its speakers, but welcomes them here to speak for the educational benefit of our clients, friends, and you, our guests. As we get started, I want to say how great it is to be here again. A special thanks to all of our staff who make this possible, including Caleb and Aaron, who are running our technology, as well as Brittany, Christian, Zena, Jackie, and Nicole. I want to extend a special welcome to those of you who are seeing us for the first time and to give a big thank you to anyone who invited you. If you do have any questions during today's presentation, please use the chat feature at the bottom of your screen and send them to the hosts and panelists. We will respond to them at the end of the presentation, and this will allow everyone who needs to leave at 3 o'clock to hear the entire presentation, but I do want to warn you, sometimes Q&A does go beyond 3 p.m. So, to get us started with today's presentation, let me please introduce Dominic DesMarais. Dominic DesMarais was raised on a cattle farm between the Minnesota cities of Buffalo, Monticello, and Maple Lake. Growing up, the youngest of 6, with parents who lived through the Depression era, gave Dominic old values. He doesn't look that old to me. His father fought in the Pacific theater of World War II, giving him great respect for veterans. The buying and selling of livestock gave him an entrepreneurial spirit that is a value beyond everything he is involved in. The financial side of business has always interested Dominic, which is why he pursued a career in marketing, sales, and finance. Dominic focuses on communication with his clients and business partners. His focus is finding the right mortgage loan for his client's financial life and goals. With this mindset, along with his interest in finance and an appreciation of excellent customer service, Dominic has successfully been in the mortgage industry since 1997. With that, Dominic DesMarais.
Thank you. I really appreciate it. And today we are here to talk about reverse mortgages. You see on screen here, actually, our director, National Reverse Director, Harlan Nicola, actually wrote this book, A Reverse Mortgage Cinderella Story. And you know, reverses are one of the most misunderstood financial products out there. And I'm honored to be speaking with each and every one of you today about this. If you have questions, we always welcome those, of course, and please put those in the chat. But you know, my first question is, why wouldn't you get or recommend a reverse mortgage? You know, if used strategically, a reverse mortgage can actually greatly improve the sustainability of your retirement income, actually give you a better retirement, potentially even more money to your heirs. So it is a fantastic opportunity that I think people should at least experience and explore a little further. You know, the feelings you may have about reverse mortgages, there's a lot of misperceptions out there. One is the bank will take the house, that ownership's given up. You're always going to be entitled to the property. There is no change of ownership. As a matter of fact, I've had some clients that sell their homes already. They use a reverse for purchase then. So again, you're always maintaining ownership. They're too expensive to consider as a solution unless things are really bad. First of all, if things are really bad, you may not qualify, but we'll talk about that a little later in the presentation. But the expense, it's about what it accomplishes, what it can do for you. A lot of times it's giving you a better lifestyle. They can save potentially tens of thousands of dollars in taxes. We're going to talk about all that today. There are so many things that this can accomplish for you. Heirs will end up with a problem and a big bill. This is actually a non-recourse loan, so the debt can never follow you to a care center, cannot be inherited by your heirs. They are risky and dangerous. This is actually a government loan. It's from the FHA, Department of Housing and Urban Development. It's guaranteed by the federal government. So it really is not what I would consider risky any more than any other government loan. But actually all of our loans, mortgage loans since 2012, almost all of them are government loans in one facet or another. They, the one thing I hear is with them is the expensive piece. And I will be very straightforward with this. The reverse mortgage is the most expensive mortgage that can be taken place. And the reason is because it's a government loan. There is 2% right up front that goes to the federal government. But you know what that does? That protects that if you ever are upside down on the loan, let's say 2008 happens again, your home value drops in half, it means that you never have to worry about being upside down. It's a non-recourse. FHA picks up the difference. So from 2008 to 2015, FHA was paying a lot of dollars of upside down homes. And if you end upside down, it actually is a win-win for you. Because what that means is you were able to spend more money than you ever would have been able to otherwise. You spent every dime of your home equity and more. So it's pretty significant. So I do hear that. And again, it's about what you're accomplishing. The other thing I'll say about expense, just like all of us don't buy the cheapest car, we see the value of having more expensive vehicles. We got to keep in mind, what will it do for you? What does it give us? And in the case of the reverse, it gives us a lot. 10,000 people a day are hitting 62 for the next 20 years, which is in retirement will peak here in the U.S. and then start to drop. Now, when I say peak, the millennials may bring that number even higher when they get there, but that's a few decades away, so let's not worry about them. Today, we're really talking about more of the baby boomer generation. 3,000 of those 10,000, about 30% of people, and actually it's a little above 30%, are still making a mortgage payment. And the problem is that mortgage payment then is coming out of your cash flow, giving you less life. And when you get to retirement, you want to have the best life you can. So be aware that that's something we would definitely want to retire those mortgage payments once you're retired. At 62, if all baby boomers retired at 62, 84% would be in jeopardy of running out of money. At 66, 50% would still be likely to run out of money. So keep in mind what those statistics are like. Only 15% of Americans actually budget their money. And the other 85% sort of pay the bills and see what's left at the end of the month. And that corresponds with the 84% that'd be in jeopardy of running out of money. So keep that in mind. There's lower savings rates today, partially because we've went from pensions, defined pension plans, to 401ks and IRAs, and not everyone saves. So that's going to be a great reflection when people get to retirement. Fewer pensions, obviously, is a challenge. Lower return on investment. Obviously, if you have money in a savings account right now, maybe you're at 0.5%, 1%. If it's really great, 1.5%. Those are significantly lower rates. So a lot of us remember from the 80s, where we could get CDs that were double digits. So, different return on investment. Greater need for safety and certainty than ever before, because the challenge is we're living longer. Now, I say challenge, it's a good thing in many ways. We're being healthier at older ages, we're living longer, we're having better retirements. But the question is, how do we fund those retirements? And that is part of what we're going to discuss today with the reverse. It is one of the methodologies that we can use. With reverse mortgages, it is an FHA loan. It's called the Home Equity Conversion Mortgage. So if you see the letters HECM, that's what that stands for, is Home Equity Conversion Mortgage. You do need to be 62 or older. It does need to be an FHA qualified home. Now, single-family homes are all FHA qualified. Most townhomes are FHA qualified. When you get into condos, then we have to figure out if that association's FHA qualified or not. But you want to talk to your financial advisor, a reverse person, someone to identify if that's the case or not. And there are some ways to help you with that too. You must live in the home more than 6 months a year, so it does need to be your primary residence. That needs to be where you're living. Now, when I say live in the home, let's say you have to go spend 2 months at a rehab facility, maybe after a surgery, getting the body moving again, you're still living in the home. That's not moving out of the home. So when I say living in the home, it's really where you file your taxes from, where your primary residence is, where you're getting your mail at. Generally doesn't affect Social Security and Medicare benefits because it is debt. It is not income. And that's something to give consideration to. So just be aware. The reverse mortgage benefits. One thing I want to say about reverse mortgages too, although I think it can help many, many people, just like any financial product, it may or may not fit everyone. So that's something just to be aware of, that you have to decide, does this fit? And that's where you want the right professionals giving you recommendations, showing you how this mortgage could fit in your financial life. So it's important if you got a great financial advisor, you work with them and see how this fits into those mechanics. But you do keep the title to your home, as I've already said. The one thing I want to point out, this is an income-based loan. A lot of people have heard of that quote-unquote loan of last resort. That's really not the FHA reverse mortgage of today. That changed back in 14, 15, where it became income-based. So if you do not plan and use this early enough, a lot of times we do have to say, no, you don't qualify. Even if you have a paid-off home, tons of equity, it doesn't matter. If you don't have the income to support it, you will not receive a reverse. So it needs to be part of the planning process. Loan proceeds are usually from 30 to 74%. Those are tax-free usually because, again, it's debt, not income. You never have a monthly payment you need to make. Now, you certainly can make a monthly payment if you wanted to, but to be quite transparent, most of the clients I see, the only reason they make a mortgage payment is for tax benefits. And we'll talk about that a little bit later, what that means. But typically, they're not making any mortgage payment, which improves their cash flow and improves their life. Keep in mind, there is no repayment needed until the last living borrower permanently leaves the home. So that means they have passed away, they moved to a care center, or they decide to sell the home. That's also leaving the home. If you sell the home, you're leaving it, right? So keep that in mind. Those are the options of when you would have to take care of the reverse mortgage. Now, if you've passed away, your heirs could certainly refinance as your additional mortgage if they want to keep the home, but that happens less than 0.5% of the time that your heirs want to do that. The majority of the time, they just want to sell the home and turn that into cash. You're never going to owe more than the home value. I talked about that a little bit earlier. This is an FHA insured mortgage. If you should get upside down, FHA picks up the difference. If you are looking to purchase a home, maybe you're in a home that has a lot of maintenance going on, steps, you'd like to purchase a different home, but you don't know how you could possibly get into a different home with the equity position you have, you can use a reverse mortgage for purchase. So in many cases, let's say you had $300,000 from the sale of your home, you could actually buy a $600,000 home with no mortgage payment needed unless you want to make one the rest of your life. Imagine what that could do, potentially moving into an association where there's less maintenance, less stairs. So things are actually available for you in doing that. There's different ways to take the reverse mortgage and what you do with those benefits. You can do a lump sum. As I talked about, you can do the purchase. You can do a refinance, a lump sum all at once. You can do a line of credit, which is non-recourse and guaranteed growth. And this is something that's very difficult, for me at least, when I first learned about the reverse to understand. And it may or may not be for you. This may be the case for you, may not. But keep in mind, if you have a $100,000 line of credit today and you don't use it for the full year, that available line of credit growth is going to grow by whatever the prevailing interest rate is. So it's 3%, 4%, let's say it's 3%. That means a year from now, you're going to have $103,000 available. And every year, that line of availability continues to increase whatever you don't use. There's no other mortgage like this. So it's the most difficult piece to understand with the reverse mortgage. But what it does is it actually allows you to get more and more equity from the home. That's why it's important to take the reverse out at the earliest age you possibly can. 62 is the minimum. You can't be 61, unfortunately. It has to be 62. Monthly loan proceed payments, you can decide for a certain length of time. You can decide a certain payment. Those are all possibilities when it comes to the reverse mortgage. How I like to look at income is really 3 buckets, which is what you see on screen here. When we're in our working years, we're paying into Social Security. Our employees are paying into Social Security. Maybe our employees are even paying into a pension plan. We expect to get paid off that Social Security and pension. That's bucket 1. Bucket 2 is everything that we traditionally consider investments, whether that be stocks, bonds, 401ks, IRAs, Roth IRAs, life insurance, annuities. That's all bucket 2. Again, when we retire, we expect to receive income off that. Bucket 3 is the savings account called home equity. Every month when you make a mortgage payment, you're putting money into that home equity. So the question is, why don't we have the home equity pay us back? Because over 99.5% of the time, our adult children do not want the home. So the question is, when do we use that bucket of money? And that's a question I ask quite frequently. What is your plans for your home equity? And most people just look at me and go, what are you talking about? Well, here's some more money available to you. So the question is, what are you going to do with that home equity? You need a plan for that. When does a reverse mortgage need to be paid back? When the owner no longer lives there, and like I said, that either is the fact that you've voluntarily moved out, you might have passed away, or it might be that 2 doctors have declared that you're not going to be moving back home. Any of those things could occur, but when you no longer live there, or you've sold the home. And obviously, so those are your options as far as when does a reverse mortgage need to be paid back. So be aware of that. It's the only thing you don't have to pay back in your lifetime. So it's sort of fantastic that way. You don't have to worry about it. FHA, which is the backer of all reverse mortgages here in Minnesota, guarantees no repayment of the loan until you've either passed away or moved out or sold the home. When the client moves out, you have up to 12 months to sell the home to pay off the reverse mortgage. So keep that in mind. If you do go to a care center, your adult children are like, what do we have to do when something happens? Then that is the time that the home may be sold, or the kids can refinance or whatever they decide to do to pay off the reverse mortgage in a lump sum. There is no penalty for early payment. Keep in mind, you can make payments anytime you want. That being said, most clients do not make payments. The loan is a non-recourse loan. If the home value gets exceeded, as I mentioned before, HUD picks up the difference. And the reason I'm stressing that so much, because so many people are like, what happens if I get upside down? What happens if I owe more than the home's worth? Well, the FHA guarantees you're never going to carry that debt with you. The heirs of the estate keep any excess from the sale of the home. So keep in mind that after the home is sold, they are going to have the inheritance piece. Now, this is a paradigm shift. It's a change in one's thinking of how we look at the reverse mortgage. The old days was the loan of last resort. That's when it was not income-based. You could expend every other dime and then go get a reverse mortgage and take money out of your home. That's not available today. That has changed 7, 8 years ago. So you do need this as part of the planning process, to plan ahead and be able to take advantage of the reverse mortgage. For people who are in financial distress, occasionally we're still able to help someone who's in financial distress, but usually they're not going to qualify. And the sad thing is, many times when I see clients, if they had just talked to us even 2, 3 years earlier when they still had assets, we could have done the reverse mortgage for them and made it where they never ran out of money. But instead they waited till they exhausted everything else, and now we're unable to help. And statistically, once a person sells their home to go rent, that money is gone within 3 years. And then they really are financially struggling. So that's why I do recommend it be part of your planning process. And that's why I talk about it. It's a financial planning tool today. Best to use it at age 62 so that home equity line of credit has the chance to grow and give you more money, more availability to your home equity than ever before. Now really, income allocation falls in 2 buckets, assets and liabilities. The assets section is the 401k, the savings, the IRAs. I've talked about life insurance, all those components. That's your asset section. The liability is the home mortgage. Again, over 30% of people are taking a traditional mortgage into retirement. So that obviously is a liability, but it also hurts the cash flow. You get to a reverse, it's the exact opposite. It helps your cash flow by giving you access to more of your home equity. And also, if you do have a mortgage payment currently, it can retire that mortgage payment. I've seen mortgage payments as high as $2,600 a month that have been retired. So a significant difference in cash flow. Now let's talk about how we got to change our mindset and how we approach the reverse as far as a planning perspective. So if with a financial advisor working with you, you work and say, what percentage of this should we take? When should we take money from reverse? Keep in mind, a coordinated strategy will give you a 78% chance of cash flow survival rate. And if you use it as a last resort, assuming you can qualify for that, which is not guaranteed anymore, it's a 60% cash flow survival rate. And the reason I bring that up, because if you use it part of the planning perspective, when the stock market has a correction, which we know it will from time to time, that's a great time to take money out of the reverse. Maybe an expense comes up, you need a car, you need the home fixed, anything like that. Maybe you don't want to take money out of the assets. Roth conversions are a fantastic way to pay for using a reverse instead of selling out part of the investment. Why not take the investment whole to a Roth conversion and use the reverse to pay for it? So it's great to have a coordinated strategy. If we look at this section here and we look down at the blue, we can see by using the coordinated strategy that we actually are able to take $1 million from 1999 to 2018 and still have $975,000 of asset availability for us to take money off of. And this is taking a distribution of $65,000 a year annually. Now, let's say we had not used a reverse and we just kept taking $65,000 through that whole period of time, you're down to $39,288. Which chance do you think gives you a better shot at making it to the end? $975,000 or $39,288? There's no question. This is why you need to have the reverse as part of the strategy, working with your financial advisor, dictating when you should take money from there and when to take money from the investments. It's about the longevity of your assets and the lifestyle that you are going to be able to maintain. So here we get into it a little deeper as far as what a passive strategy looks like. Again, you can see what the IRA values would be. No HECM, 39,288, 951. I just like to stress this. I feel like I cannot stress this enough because this is what most people don't understand. You know, someone mentioned earlier about, boy, this loan's too expensive. Well, if all of a sudden your cash flow is over $900,000 difference because you're using it in the time when there are stock market corrections, the time you should not be selling off your assets. Now, I understand we all have required minimum distributions. I'm not saying you can avoid required minimum distributions. Those have to be taken. But still, using strategically with a financial advisor, you can literally be looking at hundreds of thousands of dollars ahead by using a reverse. So that's part of the planning process. Now, talking about the pre-planning reverse mortgage uses, Medicaid. We all worry about Medicaid liens when we go to the care center. If we're married, and I worry about that, I think about that already. I'm not quite 62 yet. By the way, right after I turn 62, I will have my reverse. I'm excited to get one. But what happens is when you got a reverse, Medicaid goes into a third lien position, which protects the equity for your spouse. And that line of credit cannot be forced to be money to be taken off of it to pay for your spouse's care. So now the spouse that's left at home, they can maintain their standard of living. And that's so important. No one talks about the spouse left behind. Everyone's worried about the spouse that's going to the care center. What about the spouse left behind? How does that person continue to live and not have a diminished lifestyle? Reduce the community's spouse resource allowance. Again, reverse mortgage debt is not income. It's debt. So that cannot be forced to be used to pay for a care center. Reduce the equity to prevent selling the home. Long-term care planning. Whether you're buying long-term care insurance, whether you're using it to pay, you decide to use some of it to pay for a room so that way they can have a private room, those are all possible. Estate tax planning. That's important. Helping with making sure that you plan for this appropriately with taxes. Maybe it's buying life insurance and leaving more assets to your heirs through the life insurance, especially if you're in your 60s and still qualify. That's a great method. Foreign mortgages, traditional mortgages, payments are required, hurting your cash flow. Reverse mortgages, there's always payments optional. So here's an example, $200,000 mortgage, 30-year at 4% interest rate, so 4.116 APR. In 30 years, with a payment of $954.83, you're going to have a cash flow difference of $343,738. Now, my question is, what would you do with that money if you aren't putting it into your home equity? Doesn't that allow you potentially a higher standard of living? Maybe it allows you to take that trip with the kids and grandkids, create those memories. Possibly it allows you to buy the dream car. I've had some reverse clients that go out and buy a 60s muscle car because they always want it. And now they're like, we can actually afford it. We don't have to worry about if that's going to be using dollars that we will eventually need for our health care. So keep in mind, that is great opportunities. The most beneficial people is anyone over the age of 62. If you have 50% equity or more, or better yet, if you're still making a mortgage payment, definitely want to be talking about a reverse mortgage and how do we get rid of that mortgage payment, improving your life. Because that's really what it is. We want the right mortgage for your financial life, and a reverse does fit in with many people in that regards, although it's not for everyone. How may a reverse mortgage be used? Long-term care, whether that be insurance or just paying for long-term care, life insurance, health insurance, tax planning, we're going to talk about that a little bit more, about some of the ways it can help with taxes, and then more lifestyle. And to me, when I say lifestyle, I always say more memories, right? Because hopefully we're creating memories with our families, with our friends in retirement. I mean, why do we work all those years if we're unable to do that? Long-term care. Use a small amount of equity to protect all your other assets. Traditional monthly long-term care premiums, lump sum long-term care, or even the life underwriting that comes with a lot of the life insurance policies now that also protect for long-term care. So those are all possibilities to use for the reverse mortgage. Now, some of the costs of the long-term care and what it can cover is Alzheimer's care. You know, I know my father, as I mentioned earlier, I had an older dad. He's gone now. But he came back from World War II and built a farmhouse. And we lived in that farm his whole life. And he wanted to die in that farmhouse no matter what. And most of my clients, I find they want the exact same thing. Unfortunately, at 93, my brother and I carried him out of that farmhouse in our arms. At that point, we both thought we're probably close to the end. Turned out, he lived another 5 years to 98, and the majority of that time was spent in a long-term care facility in memory care. In today's world, at least here in the Twin Cities, that could cost up to $200,000 per year, so $1 million in health care. Are you prepared for that? Have you talked about that as a family? To me, it's so important to have those conversations. Now, my dad died a number of years ago, so we're lucky we didn't have quite that expense, but it was not cheap, let me tell you that. So meal prep, diet monitoring, light housekeeping, errands, shopping, private apartments, because keep in mind too, if a person goes to a care center, Medicaid does not pay for private rooms. It's shared rooms. So if you want a private room, you do need to pay for that. On-site nursing, help with daily living, help with medication, full-time facility care, advanced long-term care, therapy, rehabilitation, all that is there that is needed. Now, long-term care insurance can cover a good portion of that, but I find in a lot of cases, with long-term care insurance, there may be a slight deficit the reverse can help, as well as paying for the long-term care insurance premiums. So again, I think you want to do the planning piece. Life insurance. I have actually seen people in their 60s plan with life insurance. By the way, I do not have a life insurance license. I do one thing, mortgages. No insurance license at all. So I'm not telling you about your insurance. I'm just saying you might want to go check out your insurance options. I think it's very important. But life insurance, I've seen clients leave more to their heirs by buying life insurance in their 60s, using the reverse to pay for it, replace the home asset, leave a larger legacy behind. We've actually been able to show some clients how they are actually going to have more inheritable wealth by having a reverse than not having it. And the leverage of tax-free payments to heirs. And then obviously with life insurance, that grows tax-free. We talked about that a little bit earlier as far as some of those benefits. Many people can't retire because they depend on the company's insurance. So if you are retiring at age 62, like I have a younger wife myself, if I retire at 65, she will not be 65 at that time. I know my financial advisor tells me it's going to cost about $20,000 a year for private health care or private health insurance. Well, if we take that time as about 3.5 years, we are looking then at about $75,000. How is that going to get paid for? A reverse is a great way to pay for that. Buy a put on home equity without spending a dime of cash from bucket 2. So keep in mind, there is the possibility that if you have a reverse for enough years, because if you take it out at 62, keep in mind, you get to live there the rest of your life, no matter what. So there is a expiration date, but that's a 150. No one's made it there yet. If people start getting to 150, I guess we'll discuss that. But my oldest client was 104 years old. My second oldest client was 95. So you're going to live with a reverse into the hundreds, potentially, in this home, so 40 years. You would potentially have a chance of ending up upside down. But if you do, you won. Because again, FHA is going to pick up that difference. But I do want to make it clear, you get to spend the rest of your life in this house or your spouse, both of you that were there at the time of the mortgage. You can make a $20,000 payment. So one thing with tax planning, I want to talk about that a little bit. There's going to be a year that you're going to have the medical expense. It's going to occur. It isn't if, it's just when. And unless something happens quickly where you pass, otherwise you're going to have that year. And you're going to itemize that year probably. Now again, I am not a CPA either. I do not have a tax license. I'm just saying how I see many of my clients use this. That year that you have that medical emergency, you're going to itemize. That's the year to take a bunch of your tax qualified accounts and withdraw them and pay your mortgage interest that's accrued on the reverse, giving you an offset, a tax offset. And if you pay down your reverse by $20,000, that $20,000 is immediately available on that line of credit. So you actually pay less money to the federal government, and that money is still available to you. Now keep in mind, I have seen clients save as much as $60,000, $70,000 in taxes by using this plan. So when people ask, like we did at the beginning, is this too expensive? Well, what are you getting in return? If you're getting $60,000, $70,000 of tax advantage, it really no longer looks expensive. Lowest tax bracket planning. We got the taxable side, and then we have the non-taxable side. Some of Social Security is taxable. We got the IRAs, which are taxable. Now, if you got them in Roths, then they're not taxable. Hopefully you're doing that conversion while tax rates are a little lower, and a great way to pay for that is with the reverse. And then we got the line of credit, the HECM, the reverse, which also, again, is debt, not income. So that's zero tax also. Great place to use that. The psychology of the reverse mortgage, it is not the loan of last resort. If you wait till the loan of last resort, it's unlikely you're going to be able to get a reverse mortgage. So you want to get in there while you still have assets and be part of the planning tool. It's a cash management tool. It's liquid. It's the best time to get a reverse mortgage is at 62. So the closer you are to 62 versus the older years, it's better because you got that line of credit availability growing every single year, which will give you access to more money, more spending, everything you want to do, and that's all available. And again, so you want to do it as early as possible. So keep in mind the recent changes, and I want to talk about this because the loan of last resort disappeared with the financial assessment in spring of 2015. In 2014, it became that if you are married, your spouse gets to stay in that home, even if they're not on the mortgage, but they were married to at the time you took the mortgage out, they get to stay there to the end of their life. And then same-sex couples that are married or even not married, but if they're both on the mortgage, that came in 2015. I do want to point that out too, because we do see a lot more cohabitation among people who are 62 or older. As long as you're both 62 or older, you're both on the mortgage, it protects both of you the same as if you were married. So keep in mind that if you're cohabitating, and I do see a lot of that for a lot of various reasons, we can certainly help you with that. How to use a reverse mortgage. One thing you never want to do is run out of money before you run out of life. And a lot of people have not spent the time really calculating what that is. And there's one thing in common I hear from most of my clients. They say they're all spending more money in retirement than they thought they would. And I think a big belief of that is the fact that you have time to spend money. I know myself, when I work less, I spend more money, because if I'm sitting around, I'm going to find ways to spend money. When you're in retirement, you have a lot of availability of time, which means a lot of availability of spending. But you can refinance your standard mortgage, eliminate the monthly mortgage payments, still required to pay taxes and insurance, of course, maintain the home, but you have the guaranteed in the increase in the unused funds in that credit line, so that credit line increases every year. And the reason I keep bringing that up is the fact that it was very difficult for me to understand that, how I can get more money available to me every single year in the unused portion of that line of credit. To standby portfolio protection. So let's say you have a reduction in the stock market, we have a correction. That's a great time to go take money out of the reverse mortgage and maintain your standard of living and not sell low. Every financial advisor I know says do not sell low if you can avoid it. Well, this is a great tool to do that. Replace the need for the cash reserve bucket. Home loans are not usually taxable. Increase your cash flow. The ability to purchase insurance or investment products because of the change in cash flow. So those are all big pieces there. No question about it. Purchase an investment property or a second home. Tax management tool to receive deductions when needed, or a client has to withdraw less from IRAs or other taxable source. Bridge military gap from 62 to 65 for early retirees. Potential hedge against future declines in home equity because of guaranteed increase in credit line. So, keep in mind, as that line of credit's growing, even if your home value drops in half, that available credit line continues to grow. The line of credit is not tied to the home value. Gifting to family. Again, let's say your family needs money, or you want to gift while you're alive and see the joy in their faces that you're helping them at that time. And the gifting to nonprofits. What a better thing to be able to actually help the nonprofits while you're alive and see the benefits of those dollars. So something that we focus on is, who should you choose? Well, when you're looking at reverse mortgage providers, I'm a big believer, choose someone local. Someone that you can come to their office, they can come to you, you're going to have that face-to-face. Or, as I was joking around with a friend of mine today, even if we're local, maybe we're still doing Zoom, but you know where the office is, you can drop by. I have reverse clients dropping in my office every week in Edina. Some of them, I think, drop in just to say hi because that's their event for the day. Some people, they're dropping off documents, so it's great to see all the clients. You want to make sure they're a reverse mortgage specialist. They truly understand this program. They're not just having this as an add-on. They understand the strategy of planning and how that works. And then a full-service lender. The company I work for, Fairway Independent Mortgage, we are a full-service lender. We're the largest employee-owned mortgage company in the nation, and we are full service. We have all types of mortgages available. We fund $70 to $80 billion a year to over 12,000 employees. So when you're looking to decide who you're going to choose, I think that's a big component. Looking and going, okay, do I know this person's going to be here? Do I know this company's going to be here? What type of service am I going to be provided? So those are things that I would always want you to consider. And if we want to go back, talking a little bit about the spring speaker series and some of the new other programs coming up here. So,
fantastic. Thanks for all of those comments and sharing all of that. We really do appreciate it, Dominic.
absolutely.
Get a lot of questions from our clients. And for those of you who know me or know many of our advisors for a long time, the key, right, is paying for health insurance, because that's what we do. And many times people are like, I'm running out of money, now I have to change my health insurance plan, and it's often the worst time to change a health insurance plan. And so exploring and trying to understand some of the other tools that are available out there that may be appropriate for some of you, I think is a wonderful resource to have. As I mentioned in the introduction, we do have a number of other presentations that are a part of this ongoing spring series, including one on annuities, another on choosing locations for care, and a final one on estate planning. So we hope to see you in March, April, or in May. As with all of our presentations, we make recordings available. So if you're not able to make those dates either for the virtual or the live session, we'd encourage you to reach out to your advisor, ask for those recordings, and we're happy to share that educational material with you. Also, as we're wrapping things up here, I do want to encourage any of you who do have additional questions to put those into the chat, direct those to the host and panelists. We have gotten a few that have come in so far, and we want to make sure we have a chance to try to answer those as they come in. So with that, we will go into the Q&A period. I do want to begin with a question that I've been very curious for a long time, and that I think would be great for all of our listeners, right? And that's, could you walk us through a little bit of the difference between these home equity or these reverse mortgages and the home equity lines of credit that perhaps many of us are more familiar with?
Well, first of all, they're two different products completely. The thing I always want to point out is the reverse mortgage is a mortgage, not a line of credit. And let me explain what I mean by that. If you pay off a reverse mortgage to zero, the mortgage is closed and you have access to no money at all. It is done. If you pay a home equity line of credit down to zero, you still have access to money. So they are two different products. But here's what I think is the most, well, there's a number of things. One, we are looking to improve cash flow in retirement. Well, when you pick up a mortgage payment, which is what you pick up with the home equity line of credit, that's not good because it's hurting your cash flow. It's hurting your lifestyle. It's hurting what you're able to spend money on, pay for groceries, pay for food, pay for everything, health care, all the components. Now, with a reverse mortgage, there is no payment unless you're using it strategically for tax benefits, things of that nature. Now, all that sounds already bad. Well, there's two more factors we got to take into account. One is interest rates. On the home equity line of credit, if interest rates rise, your payment continues to go up, and that hurts your cash flow. And when the rates are rising, that's exactly probably when you're experiencing inflation. So you're probably already a little bit of a pinch for money, and now you got a bigger payment on your home equity line of credit. With the reverse, you have no payment unless you want to make one. And better yet, if you got a big line of credit available to you, as interest rates rise, keep in mind, if interest rates are at 3% on 100,000, a year later you have 103. If interest rates are at 6% on 100,000, a year later you got 106,000 available. So actually, if you got a big line of credit, you actually want the rate to be higher because you get access to more money. Now, the last component that I want to point out, if I can take us back in time a little bit to a terrible time in our country, September 11th, right? Does everyone recall what the large banks, right, did right after September 11th, and we were all in financial disarray. We're not sure what was going to happen. Companies quit spending. We were all worried that we were maybe going into a prolonged war, right? And what they did is they either froze or canceled lines of credit. And you might say, well, Dom, that only happened once, not a big deal. Well, actually, let's revisit. 7 years later, 2008, financial crisis. pretty much every line of credit across the country was either closed or frozen. And many were closed actually with balances on them that the payment still had to be made. Oh my goodness, it happened a second time. Right when, again, when the financial crisis was happening and you needed money the most, the home equity line was not available to you because the banks decided to close it. Well, Dom, it only happened twice. I mean, it happens. Well, yeah. Spring of 2020, COVID hits. All the national and regional banks froze lines of credit or closed them. So it's happened 3 times in 19 years. Should we assume it's going to happen again? I think we should. So let me think about this. When you're under the most financial duress, your stocks are tanking, and you don't want to sell low, is exactly when you can't access money through your home equity line of credit. With the reverse mortgage, because it's a mortgage with a line of credit, even if your home value is dropping 50%, your line of credit availability is still rising, so you have access to more money. So to me, those two products are so significantly different. It's hard to even compare. One protects you no matter what is happening in the economy.
Super. We had a question that I was pretty sure we'd get, just not sure when, and that's to see your contact information again. If you could actually change your slides to that, our technicians will make sure that that shows up on the screen for everybody. And then I'll ask you another question, and so they may
absolutely
alternate a little bit here. But so this question is a little bit specific and probably a little bit tricky.
Okay.
But it's does a reverse mortgage apply in this situation? So this particular couple is describing a situation where they have a paid-for home.
Fantastic.
And they're considering downsizing. They're 68 and 70, and they can currently support their life off of their current income, right? Social Security, pensions, the other resources that they have. They're wondering if this is a situation where there's something to be gained by using a reverse mortgage, or if this is something, just do the traditional thing, sell the old one, move into the new one, and move on.
Well, actually, this is a fantastic scenario. And let me explain why. Because we can actually help you have more money for retirement or more money for lifestyle. I don't know what, you didn't mention what price your current home is. So I'm just going to take a shot in the dark. I may be right, I may be wrong, but it's a good example no matter what. Let's say you have a $500,000 home and it's paid for. And you're thinking of downsizing. Well, I'm going to tell you what traditionally happens, and this may not be the case with you, so maybe you're out looking and you decide it's different. But many of my clients that use the reverse or purchase, when they start looking at $500,000 homes they're going to buy, it doesn't quite live up to what they expect it to be. So a lot of times they end up buying 20 to 30% more. So in this case, let's say you buy 20% more, $600,000. And you might go, and you say, but Dom, I'm downsizing. I completely get your downsizing, square footage wise. But typically, most people who buy a home in the retirement years actually want the nicest finishes, the nicest home they've ever lived in. It just may not be the largest. There's a big difference. And if you're buying the nicest finishes, all the other amenities, you might get to $600,000. I just had a client who did something very similar to this. Sold a $550,000 and bought a $700,000. But here's the great part. Now we're getting to the fun part. So you sold for $500,000. By the way, I know there's realtor commissions and everything like that, but I'm not going to take that into account for this real simple scenario. I'd be happy to get down more specific. But you walked away with $500,000 in cash, and you're like, well, we got $500,000. We want the $600,000 house. We're going to have to get a $100,000 home mortgage, but then we'll have a payment on that. Or you take out a reverse. On a $600,000 purchase with where your ages are, you'll need to bring in a little less than 50%, but I'm going to say 50% today because I like to do easy math as I'm sitting here. Don't have a calculator right in front of me. So 50% is $300,000. So you put $300,000 down. Now you don't have a line of credit or anything because you used up the full reverse mortgage buying the home. But you know what you do have? $200,000 left. What will you do with that $200,000? Will you give it to your financial advisor to invest? Will you maybe give it to your kids or grandkids, maybe help with college education? I know I just had a client who took his whole family, his 4 sons, all of his grandkids, I think he's got 10 grandkids, and they all went for 10 days to Hawaii. Maybe you want to do that and create that memory. I'm not saying that's yours, I'm just saying that's what some people do. But now you have a nicer home, downsized exactly the size you want, so probably lower maintenance, so we reduce your operating maintenance every single month. You know, you aren't worrying about the maintenance piece. We make it where you have an optional payment, so you never have to make a mortgage payment the rest of your life. and we put $200,000 in cash in your pocket to do whatever you want with. Like I said, maybe you're giving it to your financial advisor, maybe it's giving it to a charity. Maybe you have a charity that you're passionate about, but you don't want to give any because you're afraid you might run out. You still could maybe run out. Here's a chance to donate to charity. So I think that's the best scenario.
That was a fun one. I did not realize it was going to result in people ending up with more money in their pocket.
It is a lot of fun. I got to tell you, people get pretty excited when they're in that scenario. I've had many clients in that scenario. They're always like, "Woohoo! I didn't realize this." So
that is very cool. So one area that was confusing to me, it looks like it was confusing to a couple of our listeners as well, was how their line of credit, if that's how they're using the home equity or the help me here. The reverse mortgage. I'm just going to say reverse mortgage. But if they're using the reverse mortgage as a line of credit tool, right? Walk us through again how the line of credit can increase even as the market may be doing the opposite and decreasing.
By the way, just so we're clear, I have been doing mortgages for a lot of years when I started offering the reverse. The reverse is a special certification. I have to take special classes, receive special certification every year to be able to offer reverse mortgages. I had to see this 4 times. I saw it on two virtual presentations. I read it in a book and finally went and seen a live presentation in Dallas, and finally it clicked. So if you do not understand, boy, I'm going to tell you, if you get it before the 4th time, you're better off than where I was, okay? Because it just didn't make sense to me. It's actually part of FHA's mortgage. So just like if you think of traditional mortgage, where they guarantee you a 30-year payment, and this year principal and interest payment no matter what happens, that's guaranteed, right? Because that's what's in the contract. Well, with an FHA reverse mortgages, it's guaranteed that the available line of credit is going to grow by whatever the prevailing interest rate is. So it's very difficult. Now, I actually have beautiful software. I can show how this works. It's amazing. It's fun. That doesn't go well with the Zoom we're doing here today. But the point is, yes, it's very difficult to understand that the line of credit has nothing to do with the appraised value. And people always have difficulty understanding that. Well, if my home drops in value, obviously the line of credit goes up. No, it doesn't. It goes up. What? How can that be? Because it's part of the contract. That's what the federal government decided to do. Now, I'm going to be a little facetious for a moment, little kidding around, but I'm not completely kidding around. Now, this is just my personal belief, so I could be completely wrong with this. In 2014, the federal government had a choice to either get rid of reverse mortgages or to revise how they were. And obviously, we talked about those revisements today. I believe the reason they revised and kept the reverse mortgage around is they came to the realization that if they cannot get people to take out the trillions of equity that's available that we spoke about earlier today, guess who's going to pick up the tab? The federal government. So by getting people to spend their home equity and take that money out, they're actually reducing their own expenditures. That's my personal opinion. I also believe that's why they got the line of credit availability growing, because it gives people more access to their home equity. Because in most cases, but you're paying the FHA mortgage insurance up front, right? So even if the FHA has to pay out, it's covered through the mortgage insurance fund. But in most cases, they're not going to get upside down, even give that line of credit growth. But you're right. If all of a sudden rates went insane, by the way, there are caps on interest rates. So when I say this, I'm throwing out a crazy number that may or may not really be true for your particular reverse mortgage, because there's 4 different types of reverse HECMs. I wasn't going to go into all that today. We can talk about that more specific for your scenario. But let's say rates jump to 10%, which again, rates are capped. Most of our programs can't go to 10%, but let's say they did, and you have a $100,000 line of credit. You don't use it for that year? You have $110,000 available. Even if your home was worth $300 and dropped to $150, it did not matter. The available line of credit still grew by that 10% that year. So I know if you're having difficulty understanding it, I get it, because I did. But that is really how it works, and it's part of the reverse mortgage contract that FHA makes with you when you take out a reverse mortgage. So I hope that helped a little bit. It's difficult to explain without having an actual graphic where I can explain it even further, but I feel like that's the best way I can explain it without graphics.
Well, super. I do appreciate that. Does not look like we have any other questions. I'm going to give one more moment here for Caleb to double check, make sure I'm not missing anything.
Okay.
Oh, looks like there is one more. I'm just going to have to wait for it to come in. While we're waiting for that to come in. I just want to, again, encourage you to keep your eye on the schedule and your emails for upcoming opportunities to attend these educational sessions. We also want to let you know that we do encourage and look forward to your feedback on topics, on speakers, or on other ways that we can make this information more available and more easily understood. So please go ahead and share any of that feedback you may have. This looks like a technical question around your last response here. You used the term prevailing interest rate. The audience was hoping you could just define that for them real quick.
Example, okay, so there are 4 different options for reverse mortgages. 3 of the 4 are variable rate programs. So they go up and they go down depending what the prevailing interest rates are. So we just be aware of that. There's also a fixed program. Now with the fixed program, there is no line of credit available. You really is a lump sum scenario where you get all the money at once. So we do not write a lot of fixed income or fixed mortgages because it doesn't provide you the flexibility where your financial advisor can help you prepare. So without the line of credit, the challenge is if all of a sudden you want to take the tax deductions, well then that money doesn't open up again. You just paid off the interest, which is still a tax deduction, which is fantastic, but it doesn't give you that availability. Also, with having the line of credit, if interest rates are to spike and you got a big credit line available to you, it actually helps you protect against the stock market, having a correction or anything of that occurring, and you're having more availability. So that line of credit is variable. That's a variable rate. It does have caps on it. So again, depending which program we choose is what the cap is. But it actually gives you more flexibility and more availability to your home equity. And something, a lot of people say to me, well, Dom, if interest rates rise, what's going to happen with our appreciation? Well, again, past performance is no indication of future results. I'll always say that, right? However, if you look at history, typically in the rates of high inflation, we've also seen appreciation of homes. We're seeing that now. Just yesterday, as a matter of fact, Case-Shiller, who's the Cadillac of forecasts of appreciation, came out saying that we should expect nationwide an 18.8% appreciation rate of homes in the U.S. this year. Yesterday, Federal Housing Finance Agencies, so the federal government, came out with the forecast of 17.7%. So you got a private organization saying 18, the federal government saying 17. And keep in mind, the last week, the producer price inflation rate came out at 9.7%. So again, home values are outsurpassing the inflation rate. You might say 9.7, we aren't seeing all of that. But typically when the producers, which are the manufacturers of products, and also people who are providing services, when they see that, the consumer sees it 30 to 90 days later. I don't want you getting depressed about that. It's just a fact. We're all going to be fine. But be aware that that is occurring. But still, appreciation's outpacing inflation by 7-8 percentage points. Now, it's not always that great of margin, but typically we do see appreciation doing well in inflation times.
Fantastic. I'm going to roll the dice here a little bit as the moderator, Dominic. And coming back to that question, when I read that question, prevailing interest rate, I'm thinking credit cards and I'm thinking other loans in the marketplace. So I'm thinking LIBOR plus something, or I'm thinking the prime rate is published in the Wall Street Journal plus something. Is that perhaps what's going on with these reverse mortgages, or is it something else that is defining the prevailing interest rate?
Well, the prevailing interest rate is tied to the Treasury, first of all. So it's tied to Treasury rates. Now, the rate today is running right around 3%, give or take, and that is today's date. I better put it out there for regulatory purposes. I hate to say that, but yeah, we're in a regulatory environment, right? So I think today is February 22nd, 2022. So keep in mind that on that date, the reverse mortgage rate was running on the line of credit was running around 3% If we were looking back to October, November, we were in the 2s. So to me, if you look at that and you look at what the inflation rate is, because keep in mind, if you have money in checking, again, you're getting 0.5 point to a point, right? And that's something that I always want to point out. A lot of times people will keep money in cash on hand in case there's a stock market pullback, right? Well, now we'll take money from our savings account. Well, the problem is if you're dealing with almost 10% inflation and you're only getting 0.5% return, you're actually losing 9.5% purchasing power on that money. So if you're paying 3% on a mortgage, you're still gaining 6% in our, so keep in mind, that's why I'm such a big believer that the reverse mortgage, if you have availability of credit line, that you use that for your defensive strategy with a stock market pullback instead of savings accounts or other equivalents that are maybe only getting a percentage point, percentage and a half or less. So prevailing rate, we tie to the Treasury. I also go through with people the 15-year history. The highest the rates have been in the last 15 years was 2017 or 2007, right before the Federal Reserve started buying mortgage-backed securities. We were in the sixes then. And then the 2 years right before COVID, which by many measures we had the best economy in 30 years. And the Federal Reserve quit buying mortgage-backed securities and treasuries, and the rates went into the fours. Still, when you consider fours, considering 9% inflation, I mean, we're still looking at very reasonable rates. But today we're looking more in the threes. Did that answer the question more thoroughly?
I think we did get to the same place there, so
fantastic.
I appreciate that. The answer that I heard was tied to treasuries.
That's fair enough, but I want to give actual numbers because everyone's like, well, what's a treasury? What does that mean? What's the margin on the treasury?
Well, the nerd in me wants to go 2 years, 10 years, 30 years, but we won't go there. We'll save that.
But that's a whole other discussion. I can go there if you want, though.
Exactly. So, well, I do want to wrap this up. I know we're getting very close to 3 o'clock here, and I appreciate the comments in the chat as well about today being a very special day for those of you who are number geeks and looking at it being February 22nd, 2022. And we also, during this presentation, ran through 2:22 p.m. So some of you probably enjoyed that as well. For those of you who are on military time, you'll get another shot at this at what I would call 10:22. You may call 22:22. That may be the best time of the day for some of you. But again, I want to tie this up. I want to give one more thanks to Dominic. We really appreciate your coming out, sharing your knowledge and all that other information with you. Guys in the booth, if you want to throw up his contact information one last time in case anyone wants to use that, and you're welcome to reach out him directly. So. Hope you guys all have a great day and look forward to seeing you at our next one in March. Thanks so much.
Thank you.